Hey everyone, and welcome back to your Money Your Way YouTube channel. If you live in Singapore, chances are you've grabbed a Kopi, had breakfast, or maybe even dinner at a place like this. These heartland coffee shops and food courts are practically institutions, right? Well, today we're diving deep into one of the biggest names behind many of these familiar spots, Kimly Ltd, trading on the Singapore Exchange under the ticker 1D0. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. Is this Singapore food court giant a hidden gem for investors? Or are there things we need to watch out for? We'll break down their business, look at the financials, weigh the pros and cons, and see how they stack up. Let's get into it. So, who is Kimly? They've actually been around since 1990, so they have deep roots in Singapore's F&B scene. They listed on the SGX Catalyst board back in 2017. They're one of Singapore's largest traditional coffee shop operators. Think about their network. As of their latest reports, they operate and manage over 80 food outlets. This includes your classic Kimly coffee shops, industrial canteens, food courts under brands like Food Clique, and even halal coffee shops called Kopi. But that's not all. They also have a big food retail division with over 170 food stalls selling everything from mixed veg rice and dim sum to seafood cha. Plus, they own restaurant brands you might recognize, like the Japanese chain Tonkichi and the popular halal brand Tenderfresh, which they acquired a majority stake in a few years back. They even have central kitchens supporting these stalls. Basically, they're a major player woven into the fabric of everyday life in Singapore, aiming to offer affordable meals while trying to modernize. Alright, let's talk positives. What makes Kimly potentially interesting for investors? First up, resilience and diverse income. They don't just rely on selling Kopi. They make money from selling food and drinks directly, plus they lease out stalls to other operators, and their occupancy rates are consistently super high, around 99%. They also manage outlets for third parties and even invest in the properties themselves to secure good locations. This diversification provides stability. Second, strong local presence and brand recognition. Kimly is a household name in the heartlands. Their focus on affordability is a big plus, especially now with rising living costs and the GST hike. People need affordable food options, and Kimly provides that. Third, solid cash flow. This is a big one. Kimly consistently generates strong cash from its operations, often significantly more than its reported net profit. Why? Mainly due to non-cash expenses like depreciation on their properties and equipment. This strong cash flow gives them financial flexibility for paying dividends, investing, and managing debt. Fourth, the dividend. For income investors, Kimly has been quite attractive, offering a dividend yield recently hovering above 6%. Their payout ratio is quite high, meaning they return a large chunk of profits to shareholders, but that strong operating cash flow we just mentioned helps cover it. And finally, strategic moves. They're not just sitting still. They acquired Tenderfresh to tap into the halal market. They're expanding their central kitchen operations for efficiency and investing in technology like self-service kiosks and digital payments. Okay, it can't all be smooth sailing. What are the potential downsides or risks with Kimly? The biggest challenge right now seems to be margin pressure. Management themselves highlight rising costs. Manpower is expensive and hard to find. Raw materials cost more, utilities are up, and so are rentals. These rising costs have been squeezing their profit margins, and net profit has actually declined in the latest fiscal year despite revenue going up slightly. This leads to the next point: slowing growth. While revenue jumped significantly after they fully included Tenderfresh, growth in the last couple of years has been more modest. Is the core business facing saturation or slower organic growth? Then there's competition. Let's be real, the F&B scene in Singapore is incredibly competitive. You've got other big players like Food Junction, Food Republic, and historically Kopi, though they delisted, not to mention countless smaller operators. Kimly is also very much a Singapore-focused business. While that gives them deep local expertise, it also means they're heavily reliant on the health of the Singaporean economy and consumer spending habits. An economic downturn here could hit them harder. Finally, financial leverage. While their ability to cover interest payments is strong, their reported debt-to-equity ratio saw a big jump in FY 2024. Now, a large part of this is due to accounting for leases on their many outlets, not traditional bank loans. In fact, they have more cash than loans, resulting in a negative net debt position. Still, the higher overall leverage figure is something to keep an eye on. So how does Kimly compare to some of its listed peers here in Singapore, like Jumbo Group, famous for chili crab, or Old Chang Kee, Curry Puff King? Looking at return metrics like return on equity and return on invested capital, Kimly puts up respectable numbers, showing they generate decent profits from the money invested. However, recent figures suggest they might be slightly behind Jumbo and Old Chang Kee on these efficiency measures. Interestingly, Kimly's profit margins, particularly its net profit margin, seem to hold up relatively well, comparing favorably against Jumbo, though maybe slightly behind Old Chang Kee's recent net margin. In terms of valuation, its price-to-earnings ratio seems quite reasonable, generally in line with or slightly below its peers, suggesting the market isn't pricing it at a huge premium. So, wrapping up on Kimly, we have a stable, cash-generating F&B giant deeply embedded in Singapore's heartlands. They have diverse revenue streams, a strong brand focused on affordability, and they pay a decent dividend supported by robust operating cash flow. However, they are facing significant headwinds from rising operating costs, which are pressuring their profitability and have led to a recent dip in net income. Competition is fierce, and future growth seems tied to navigating these cost pressures and successfully executing their strategies, like expanding the halal segment and leveraging technology and their central kitchen for efficiency. Management sounds cautiously optimistic, focused on network expansion, potential acquisitions, and efficiency drives. The big question for investors is, can these efficiency measures truly overcome the inflationary pressures and reignite profit growth? Is Kimly a buy? As always, it depends on your investment goals and risk tolerance. If you value stability, strong cash flow, and an attractive dividend yield from a well-known local brand, it could be interesting. But you need to be comfortable with the margin pressures, the reliance on the Singapore market, and the need for their cost-saving strategies to pay off. Alright folks, that's my take on Kimly Ltd. Now, super important. Remember, this video is purely for informational purposes and reflects my analysis of publicly available data. It is not financial advice. Investing involves risks, so please always do your own research and consider consulting with a qualified financial advisor before making any investment decisions. Now I want to hear from you. What are your thoughts on Kimly? Are you a shareholder or thinking about it? And just for fun, what's your go-to order at a Kimly coffee shop or food court? Drop your thoughts and favorite stalls in the comments below. If you found this video helpful, give it a thumbs up, subscribe to the channel, and hit that notification bell so you don't miss our next Singapore stock deep dive. Thanks for watching, and I'll see you in the next one.